Hello and welcome to the Mutual Fund Show. My name is Neeraj Shah, and over the next 30 minutes, 25-30 minutes, we'll talk all about mutual funds and specific aspects of funds. Now, if you saw our invite to you to watch our show, we're going to talk about smart beta, or as in the US they say smart beta, and how good or how important or how could you track and what is smart beta in the first place and how could you make use of it. But remember, as we do every show, before we get to the crux of the show, we talk about the big question of the week. With us, our experts to talk about everything related to mutual funds, smart beta, and of course, the big question of the day from the DSP team. Need no introduction. Kalpen, Parekh, Anil, Ghelani, gentlemen, thanks so much for joining in. And the big question for the week, before we get to the topic at hand, is everybody suddenly waking up to the fact that banking is the big space which is rallying. Now, about 6 months ago or 7 months ago, being invested in a BFSI fund was filled with dangers. NAVs crashed, etc., etc. The last 1 month, the scenario has turned around completely. Is it a good idea, if you have, either of you have views, or is it a good idea to own a BFSI or a banking fund? Any house, but is it a good idea to do that? Any thoughts?
Okay, so let me respond to that. Like you said, few months back, there was a lot of cynicism around banking because of the liquidity crisis which happened, and banks, NBFCs, all of them went through significant round of volatility. So this is nothing but the reversion to mean trade which plays out. So this happens every time whenever there's a sharp correction in a certain sector, some reversion to mean would happen. And in our view, banking, for example, banking and financial services is roughly 1/3 of the benchmark from a weight point of view. So if an investor says that if the benchmark has 1/3 weight in this space, and if I'm investing in active funds, which also roughly have 1/3 the weight, the choice of stocks could be different. But I want to exercise or express a much larger conviction and have a larger exposure of banking and financials in my portfolio, then for a hypothesis like that, it would make sense to be in a banking and financial services fund. And fundamentally, the hypothesis here is that as the economy really formalizes and grows, finance is the lifeline. So good companies which are providing finance and well managed from a risk point of view will continue to do well. So I think the hypothesis here is, see, in finance, typically in banking, you have 1 rupee of equity and 5 to 10 rupees of leverage and debt, and then that gets deployed. So if the lending is good, your ROEs can be significantly better. And if few lending accidents happen, then that can create the flip side of it. So every few years you have these type of sharp fluctuations. And it's always good to invest in good companies when the headlines are negative.
Okay, so well, the last line is maybe the key takeaway for this. I hope somebody who's wanting to know about whether or not it's a good time or good idea to invest into banking funds gets the idea, gets some thought out of this. But today on the show, we'll be discussing about the pros and cons of investing in smart beta funds. The question is, what is smart beta? Of course, a lot of people might not be aware of it as well. And my opening question to both of you would be that while we're talking about smart beta, which is a new concept, if we take a look at what the Vanguard founder Jack Bogle said in an event in London Business School and on a podcast with a Bloomberg anchor as well, he warned against the dangers of allocating money to smart beta funds, saying that he's wary of new financial instruments that haven't been tested by a big shock in the market. And he said, and I quote, "Smart beta is the big new thing. I wouldn't quite say it was stupid, but it makes claims that are beyond its ability to fill." Why are we talking about smart beta?
Well, I think there are different angles to it. If we try to simplify smart beta in a very basic way, if we look at the...
Yeah, let's start off with what is smart beta.
In a very basic way, if you look at the risk and return of any stock, you can break it down into 6 or 8 factors. An interplay between these factors and packaging of that is something what you can define as smart beta, simply put.
Can you simplify this further?
I'll take it simplified with a different example. Let's say recently in January, we saw the marathon. Suppose somebody is preparing for the marathon and you have been given a diet that you need to have X component of carbohydrates, Y component of proteins. Then once you get that diet, you don't look at what food you are eating, but you slice through that and make sure that by the end of the day, that much quantity of carbohydrate, proteins, etc.
The nutrient gets you.
Get done. Similarly, Smart Beta, what it does is that if you have decided that in your portfolio you need X quantum of growth, Y quantum of momentum, so much lower quantity of volatility, for example, then you don't look through any other aspect, but make sure that your portfolio gets these factors in that proportion that you want. And a product that can package that in the quantity and the manner in which you want would be defined as a Smart Beta.
Okay.
So let's say if you look at from global context, the Smart Beta products are very popular. In Indian context, they are starting to pick up now.
Yes.
So simplest form of Smart Beta one can think of is equal weight. We did an equal weight product about 1.5 years back on a Nifty. So we did a Nifty equal weight as a simplest form of Smart Beta, and we offered it to investors in India. Now we will go gradually to next stage where we are trying to work on creating a new product which will have 3 factors which are combined together in a very simple manner, packaged as a product.
Okay, no, but let me come to the basic definition, guys, of what Smart Beta is. And I presume that it combines the benefit, as I read it, of passive and active investing strategies as well, right? So for somebody who is wanting to know, why is it that I should look at something called Smart Beta? What would the response be? Why do I need a Smart Beta product in my portfolio?
Okay, so let me try to answer not in a marathon analogy, because I don't run. So, there are passive funds which give the returns of the market, which is called beta. So if the market goes up by 100 rupees, you get 100 rupees, which is the beta of the market. And then there are active funds, which have largely been the mainstay of Indian mutual funds for the last 2 decades, which say that if the market gives 100, I'll give 103 or 5. That's my intent. And over the last 20 years, that intent has largely been shown, which is through the generation of alpha. So you have passive on one side, which gives you the beta of the market. And then you have active funds, which largely make money. So if the beta of the market, let's say, is 12%, and an active fund has generated 14%, so 12 is the market return itself, and the 2% extra is your active alpha. What does Smart Beta say? It says that what are the drivers of return, of excess return, of the active fund manager. So if there are successful active fund managers in India or around the world, there are few principles that they have followed consistently, time over time, again and again, in a consistent, repeatable fashion. These are called factors. So you try to extract what is the source of this extra alpha. So for example, for some fund managers, the source of alpha could be buying good companies at cheap prices. So valuation is a factor. For some fund managers, buying growth companies. So high growth rate is a factor. For some fund managers, just focusing on the quality of business and high ROC companies is a factor. So there are some 12 factors around the world. At its core, we are saying that 3 factors largely contribute to most of that excess alpha, which is, good companies, which is quality, growing well, which is growth, and bought at reasonable prices, which is valuation. If you are able to extract these sources, and that is what most successful managers in India have demonstrated as their alpha. So what we are saying is that, okay, let's now code for these 3 principles and convert that into a rule-based passive product or a rule-based fund, and try and eliminate the human bias or the human intervention and package it in a passive product with the source of alpha that an active fund can have.
How does one do that?
So the way you do it is, let's say you have, again, I'll give an example of Nifty, which is our largest benchmark, 50 companies. These 50 companies will have companies across sectors. And these 50 companies will have different parameters. So there will be many companies with high ROCs, but there will be few companies with low ROCs also. There will be many companies which will be very expensive, moderately expensive, and cheap. A Smart Beta will say that, okay, if I want to build a Smart Beta on Nifty, I only want to take the high ROC slice, and I do not want the low ROC companies. Because of business cycles, for example, a lot of corporate banks currently will be going through very low ROEs. A Smart Beta product which is designed around high ROEs will exclude these companies. So the index will exclude companies which are below a certain threshold of ROCs or ROEs. So if my defining factor is quality, and quality is generally defined through ROEs and ROCs, and it will have a filter. Let's say that filter is companies with more than 15% ROEs and above. Then from the index, you eliminate companies which are lower than this ROE, this parameter, and only choose the ones which are above that parameter or about your threshold. So from the beta or from the passive product, you are eliminating what you don't like as a fundamental principle, and you are choosing what you like. Now, so out of 50 stocks, you end up choosing 30. But those 50 stocks will have certain weights because there were 50 stocks, but now we have only 30 stocks. So the weights will also get realigned.
Okay.
So let's say if, as an example, if HDFC Bank is 9% in the 50 stock universe, but now the stock universe has become 30, so the 9% weight will increase to maybe 11 or 12%. So, so what you like, you are allocating more capital towards that. And you know, and what you like is again a function of your belief. So multiple smart beta ideas will have, you know, unique beliefs. So I may have a belief that I want to only buy the cheapest company from this range of quality. So then you can optimize for valuation after you have taken out a slice of quality and growth, and then you optimize for valuation. So primarily what you're trying to do is say that what are the sources of long-term excess return that an active fund manager has always used, and you convert them into a rule-based format and convert that into a passive structure then. So that if you know for that matter that a lot of corporate banks could turn around in the next 2-3 years, ROEs will kick back and come back, and the stock could do well. But this filter eliminates them, so be it. The human bias will not come in to say that I know that this view is going to change, and hence I want to still have a corporate bank in the portfolio. So the active fund will capture a lot of turning points. A passive fund may not capture the turning point. So that could be a drawback. But at the same time, it may not make mistakes, which many times active funds could make in trying to have human judgment. The benefit of a human judgment is you can capture, you know, some turning points very well. At the same time, human judgment can go wrong at different points in time. So the fundamental original thought of passive is always about, you know, trying to eliminate human bias or, you know, significantly reduce human bias. So smart beta funds basically combine the benefits of passive and the benefits of active. So they are formula based or rule based, so that the passivity comes from that, and the active part of an active fund, which is the source of alpha, gets integrated. Okay. And that's how you blend the two.
So then guys, am I right in believing that the difference between a smart beta fund and an actively managed large cap fund, which will also aim or strive to get the best companies, is that the actively managed large cap fund can buy and sell a company depending on the fund manager's wishes? In a smart beta fund, you will set the guidelines beforehand.
Absolutely.
And those guidelines will stay true throughout the life cycle of the fund.
Absolutely. Correct. So the human bias is eliminated. So it's an automated strategy.
Why does this work? I mean, have you guys done some studies to figure out that this works?
So I'll give an example of the simplest, most original form of smart beta, which Anil highlighted, the Nifty, the equal weight strategy. So in US, or let's take India, Nifty in its current form is a free float market cap based weightage formula. So the largest stocks get large weight, so 8%, 9% is the weight for the top stocks. And the stock number 45 to 50 will have very small weights like 0.3, 0.4, 0.5. The elementary form of smart beta is to say that, you know, rather than giving these type of weights to different companies, let me weight them equally and let every company get an equal weight of 2. Which means the top 10 companies will also get 2%, and the bottom 10 companies, stock number 41 to 50, also gets 2%. So a lot of stocks which are entering into Nifty and probably are, you know, high growth companies or companies which are likely to be value creator over time, but are getting a very low weight in Nifty, will get some respectable weight of 2%. Now, we have evidence or data since 2003, so roughly around 16 years of evidence.
Almost 99.
99, so yeah, we have 18 years of data. Now, 18 years of data shows that around 11 out of 18, the equal weight strategy has outperformed the market cap weight strategy. 2 out of 18, both have given equal numbers. So effectively 13 out of 18 either is same or better. And 5 out of 18 years, the market cap weight strategy does well, which was the case in the last year, where the top 7 stocks gave 80% of the return. So in the last year, the traditional Nifty would have done significantly better, roughly 8% alpha over equal weight. But over long periods of time, equal weight has generated around 2.8% CAGR alpha over the last 18 years.
But this is better compared to the Nifty 50 returns
Yes.
or to an actively managed large cap fund return?
So in its first step, this is 2.8% better than the Nifty in itself, which means over Nifty it has generated an alpha of 2.8, number one. Now the next question is that when you look at large cap funds, what is the size of alpha that large cap funds can compare over the next 10 years? Now, if large cap funds can do 1.5, 2% alpha, it's a fairly commendable job. History says that a pure Nifty equal weight has delivered that type of alpha. So in a way, it can be a replacement to the pure large cap strategy, number one. Number two, comparisons in India in a way are not fair with a large cap fund because, even today a large cap fund can buy 20% in mid cap stocks.
Yes.
Even after the new SEBI classification. And prior to that, for the last 20 years, large cap funds could actually buy 35% in small and mid caps. So a lot of returns of the last 20 years may not be truly comparable to Nifty. But now incrementally, I think, both will be compared like to like.
Okay. Anil, you want to add to this? And I mean, just a thought on why is it that the nature of this kind of investing, which is equal weight index, and that's one example, but let's stick to that, could be beating an actively managed large cap fund. The actively managed large cap fund, for example, now I reckon will have a choice of not just the Nifty 50 stocks, but 100 stocks, and the fund manager will have a choice of giving a much higher proportion to, let's say if he wants a Britannia which is entering the Nifty and therefore will have lower weightage, but he believes that the growth is high, can actually have a disproportionate amount of Britannia in his portfolio any which ways. So why is it that a smart beta fund with equal weights will beat an actively managed large cap fund?
One very important thing, I think, what even Kalpen mentioned earlier, is to eliminate human bias. No doubt, so actively managed fund will also have the capability and overweight, let's say, a particular stock. On the other side, what that weight should be or how overweight should the proportion be taken, that is a subjective element which maybe is working fine for a certain time period, it can go wrong as well. Here it's eliminating that and saying, okay, fine, this particular new stock which has come into the benchmark, let's say is 0.5%, I'm by default making it 2%. That is a reasonably...
It's a requirement.
And that makes it reasonably largely overweight. So now let it perform in that context. Having said that, another one aspect is that, as Kalpen also mentioned earlier, this is more so true in the large cap space. Let's say the top 100 companies by market capitalization. If you look at the research coverage, if you look at the way in which information is available, let's say on a strong platform like yours, immediately information is available of any company, any management decisions, changes, etc. So in that sense, the access to information, the research coverage of these type of companies and all has increased so much over the, let's say, past decade or two, that within that pool, it's becoming a little bit more difficult to outperform the benchmark. At any point, I'm not saying that outperformance is not possible, or I'm not saying that generating the or beating the benchmark is not feasible. It's just becoming more difficult as compared to the past.
Okay.
I just wanted to add that a good fund manager will still have the right wherewithal to generate alpha or outperformance, whether to Nifty or even in equal weight, because then it's about how good the driver is. So, even if all else being equal, if both the cars are equally good and the road is, equally as it is, a good driver will probably maneuver right. In the large cap universe, our sense, when I talk to our fund managers who manage the large cap universe, is that being a little bit away from consensus, being a little bit contrarian, having a streak of value investing, being slightly different than what the rest of the market is, could be a source of alpha. Having said that, and for example, if today 35% weights is in financials, so a fund manager may say that I think if I also keep 35% weight, I will still get more or less similar outcome as Nifty. So to do different than Nifty, my portfolio has to be different than Nifty. When I run a portfolio different than Nifty, there can be periods of time this portfolio could underperform. And many times investors are not patient enough at times with that patch of underperformance. So a fund manager who has that temperament, discipline, behavior, to say that I will live with few quarters of underperformance because my medium to long-term hypothesis is still fine, will still have a reasonable chance of outperformance. And but I think that will be incrementally getting limited to few.
Okay. So risk reduction, return enhancement, improving of diversification, cost savings as well. Are the costs different in a smart beta fund vis-a-vis some of the other funds? Any thoughts here, gentlemen?
Well, I think the first 3 points are most important.
Okay.
Reduction of risk, increased potential for returns, and better diversification. I think these are the 3 core aspects.
Core aspects.
Cost, no doubt, is there, but I think in Indian context now, there are multiple other factors playing in the context. So, cost reduction, I think, would be a factor, but I think not such a big important
Okay,
factor.
so who should use smart beta funds? I believe you guys believe that if the goal is to outperform the passive benchmark and if the goal is to diversify from heavy allocation to mega cap stocks, right?
Okay, I won't say necessarily only heavy allocation to mega cap stocks. I'll say that what is this fund's objective? Its objective is to choose the right investment principles. I would answer this in 4 lines. Basically, what is a good investment hypothesis for long periods of time? Buy good companies at reasonably right prices. Sometimes they are available, sometimes they are not available. And once you have been able to do this, generally do nothing. Don't disturb that compounding. And to do all 3 of this, the 4th important dimension is reduce human biases. I won't say eliminate, because elimination is impossible. So if human beings are doing the first 3, the 4th dimension also is likely to come in. Our own personalities and our own biases and temperament and the noise of the market can come in. There is a school of thought which has globally been more developed and is just starting off in India, is that the first 3 can be done with significant reduction in the 4th through rule-based products. So whether we call it smart beta, we call it passive, we call it rule-based, we call it quant, there can be different names, but fundamentally you're doing just these 4 things. You're trying to do what good fund managers are doing and trying to curb the biases. And sometimes these biases also come because of day-to-day comparisons. The fund manager is trying to generate long-term returns by playing a test match. But if the empire is a T20 empire and the run rate is of a T20, that becomes a challenge. So I would say that there is merit in having a part of your portfolio in a rule-based product where the rules are fundamentally designed. There are 2 types of quant. One is technical quant. And I don't have expertise to comment on that, whether it works or not. But I believe, and we believe as DSP, that fundamentally designed rules, if rules have fundamental principles of, picking up good companies, picking up the right prices, eliminating weak companies, eliminating companies with red flags, high beta stocks, more volatile stocks, if rules are defined with the right principles, and then the model sticks to it and does not keep changing and remains consistent, it's a very good ingredient for long-term value creation.
Okay, interesting. Now, you mentioned at the start of the conversation, Kalpen or Anil, that there are different forms of smart beta. I believe the one in your portfolio is the one which has got equal weights. Currently. Are you guys planning to have more such products? And what has been the performance of that product that you launched? Maybe it's too early because you look at funds over 5 years and not 1.5 years. But if you can give some glimpse about what the performance has been, how is it done vis-a-vis comparable other products, and what are the plans going ahead for the same product or same set of products?
So equal weight, like I said, in its 19-year history, 5 years, random pockets of 5 years, it underperforms its peer, which is the market cap based product. So last year was one of them. And like I said, the top 6 stocks, they call it Ritik, HDFC, Reliance, Infosys, TCS, HDFC Bank, IndusInd Bank, and Kotak. These 7 stocks generated 70% of the market's return. And these stocks had roughly around 45% weight in the traditional Nifty, whereas equal weight would have 7 into 2, only 14. So it can't run at the same momentum. So last year was a year of massive underperformance, but this will change. Basically it reverts to mean.
Sure.
When Nifty equal weight does very well versus Nifty, it will revert to mean. Likewise, it underperforms, it will revert to mean. Now, generally, purely looking at data, historically it has been seen that whenever the underperformance is roughly around 11 to 12%, the reversion to mean tends to happen. Because end of the day, it's the same companies you are owning, just the weights are different. So we hope that, the last year's underperformance was roughly around 10%. That number has now moved down to 8. So the reversion to mean trend has just started in the last 2 months or so, where the next 40 stocks are also gradually, performing relatively better. So that is the example of Nifty equal weight. And what gives us confidence is that if we look at it, it's rolling return. If you've invested at any point in time on a 3-year or a 5-year rolling, the odds of it outperforming Nifty have been very high on a rolling basis. So for an investor, rolling is more important than a calendar year, because I could come in any time and stay for 3 or 5 years. So that's one part on the first smart beta product that we had. The second one that is in design right now, we have got an approval. We will launch it either in April or May. We call it the Quant Fund. Starts by blending 3 factors. So it has 3 factors of smart beta. The first factor is quality, the second factor is growth, and the third factor is value. So it blends the 3 and then gives weights according to how each company scores on an aggregate basis on all these 3 factors. And very importantly, it starts with a very fundamental hypothesis that to succeed, don't fail. So what are the type of companies which have historically failed? If you notice, companies with very high leverage generally fail. Companies with poor governance fail. Companies with high volatility and stock beta underperform. So we started by saying that let's eliminate what in the long term has failed. So you take 200 companies and put it in an elimination formula. It straight away eliminates 100 companies. So you're left with only 100 then. Then in this 100, you eliminate companies with red flags. You're left with only 45.
Sure.
And in this 45, you apply these 3 quality factors and then optimize for their weights. So it's a very interesting concept where we are packaging 3 fundamental principles of good investing: buying good growth companies, buying good quality companies, and optimizing for valuation. In today's market, probably everything is expensive, but you try to give respect to relatively cheaper valuation. And then the 4th filter is try to do nothing for long. As long as the company is delivering, don't try to disrupt it by bringing in your human biases. Let the compounding run. So even the portfolio turnover we are attempting should be, let's say, closer to 30-35% versus traditional portfolio turnover, which could be 70 or 80%. So with that framework, and then typically in quant funds, the design of the model is very important. So we've tried to design the model with a lot of stress testing, not back testing. Back testing sometimes makes models look good. We have stress tested that what can go wrong. Cost can go wrong, recency bias can go wrong, impact cost can go wrong. So we have tested for the worst, and the results look good so far.
Touch wood for that. Final question, and Anil, I remember when we did a show a few months back, you were on the side of believing that passive investing too has a future even in a country like India, which is largely actively managed right now. We see smart beta adoption on the global level increasing over the years. Do you think that India, this adoption of smart beta products would only go up? Is there a legitimate chance for that?
Oh yeah, most certainly. I think I still hold the ground what I mentioned earlier, that within the overall context of having a asset allocation in any individual's portfolio, definitely passive investments will play an important role. It will increase over time as a complementary strategy, and it will not be just plain vanilla passive, but even some smart beta products. So it's, a given, as we just discussed earlier, looking at these 3 benefits, that better returns profile, lower risk profile, and wider diversification as compared to a normal other product. So it's a very clear-cut thing from the growth perspective.
Okay, quick question. Either of you, just out of time completely on the show, but if you were to make an allocation, 25% passive, 70% active, would that, if that is the ideal one, would smart beta be in the side of the weightage of 25% passive, or would it be in the side of 75% active?
So I would put it in the 25% passive.
What about
in
you,
that
Anil?
bucket.
You can differ from him.
Yeah, no, so, yeah. No, I think I would tend to agree with that. I think it makes very logical sense to.
Okay. We're coming from a 20-year, 2-decade period of active funds having created a lot of value. So we still feel that value will continue to prevail. But over time, if that fundamental hypothesis changes, then the numbers could start changing dramatically. So all the provident fund money, EPFO money in the last 1 year has straight away come in passive.
Okay.
And thankfully, or maybe good luck, passive has done better than active in the last year.
Yeah, that is.
So they have started off with a big bang by being in passive funds.
Okay, interesting. Gentlemen, so good talking about this. It's a concept that a lot of people wouldn't know. So I'm hoping that via this show, a few people get introduced to this as well. But thank you so much for joining in today and giving us your thoughts. And all the best with your passive products.
Thank you.
And your high beta products, of course. Smart beta products, sorry, not high beta products. Happy Holi to you and your team at DSP.
Thank you, it's the same.
Thank you so much. And viewers, thanks for tuning in to this leg of the Mutual Fund Show. Wishing you all a very happy Holi.